everything, every category. I mean, whether you look at median income, whether you look at employment or unemployment, no matter what chart you're looking at, it's either ever or 50 or 60 years the best numbers. It's probably the best economy we've ever had.
Joining us right now is Harvard economics professor, former Reagan economic advisor, Marty Feldstein. Good to see you, Marty. Thanks very much for joining us.
Good to be with you.
How do you assess things right now?
Oh, the U.S. economy is in great shape. Every measure that you look at, unemployment, wage growth, even the official statistics understate how much progress we're making on wages because they don't take into account the fact that older workers who are retiring have higher incomes than the young folks who are coming in. But what worries me is not what's happening now, but what will happen as long-term interest rates rise.
So you do worry that rates are going to cut into some of this growth at some point?
They'll cut into the growth and they'll cut into the market.
Yeah, I think it's important to note that one of the reasons why we're back at the top of this list in a decade is because of fiscal policies brought on by this administration, where they deregulated and they did tax cuts because we had the most obstructive corporate tax policy in the world. We had one of the highest rates. And this study stated that America's vibrant entrepreneurial culture and its dominance in producing a competitive labor market and nimble financial system are primarily the factors. So don't we need a monetary policy that can react to that can serve as a referee where they do raise rates, where inflation's going up? The short-term rates are actually still lower than the rate of inflation,
Absolutely.
so it's still a conducive, policy.
So the Fed should have started raising rates, as I've said to Maria on this program, 3 years ago. And so they're way behind the curve. The federal funds, the overnight rate that the Fed moves is less than the inflation rate. So that's no place to be.
So that was Janet Yellen then. Janet Yellen should have raised rates sooner.
Should have done it sooner, right. So we've run a decade of negative real rates, and that's put us in a bad position. The problem is not so much inflation as it is that when the economy turns down, the Fed has no ammunition. They can't. And so that's why they have to gradually push up the rate.
Well, we've seen what they can do in terms of blowing out their balance sheet, taking it from less than $1 trillion to, what, $4.5 trillion at the very high. I want to ask you about the 10-year yield, though, because, again, does that represent right now where it is optimism in the economy? At what point does the yield on the 10-year become a real problem?
It becomes a real problem when it gets to 4+ or 5, and I think that'll happen. Right now, it's a little over 3. It's doubled in the last 2 years. So, and it's moving up, and it'll move up more with inflation. It'll move up more when the market has to absorb $1 trillion a year of government deficits. And it moves up because the Fed is on this path to gradually raise the short rate. So all of that is going to push up the long rate.
But 4%.
Marty, Thomas Honig, the former Kansas City Fed chief, said the same thing about interest rates. When they're artificially low, you don't have ammunition that you can launch. If you have a systemic problem like oil prices go higher, how long can we mitigate rising rates as far as the economy with these tax cuts? When you guys cut taxes in '87, the GDP goes from 3.5 to 4.2. Bush tax cuts went from 1% to 3.8. We're seeing the same type rise right now. How long can that be mitigated?
That's a good
by
question.
the Fed or
No,
by in general?
I'm sorry, in general in the economy, because right now the rising interest rates are not affecting the economy as much because these tax cuts have more than mitigated the effect.
That's right. So I think...
When does that equilibrium hit?
Well, I don't know what day, but it's going to hit. So we're going to run out of the extra steam that comes from cutting rates. We're going to continue to have the advantage of better regulations. We'll continue to have the advantage of lower corporate rates, but the extra boost that you get from cutting the corporate rate and cutting personal rates, putting $1 trillion a year into the economy, that's not going to continue to generate stronger growth.
Could the midterm elections change that? I mean, does it threaten it? I mean, the president basically warning of a potential economic downturn if Democrats take control of Congress. Here's what he said yesterday to Trish.
They'll take away your tax cuts. They'll put rules, regulations. You'll start losing jobs. This would be a terrible thing for the country if that happened. Look at 401ks. So let's say we have a really bad time in 3 weeks from now. Your 401ks are going to go down tremendously. People are going to lose wealth. If they don't go out and vote, then they have themselves to blame because they'll lose wealth, tremendous amount. I built up $11.7 trillion in wealth.
What do you think about that?
I don't think the Congress, especially Democrat control of the House alone, is going to change economic policy. Economic policy of the Fed, independent of all that. The tax cuts are there. The Republicans will continue to control the Senate, so we're not going to get a tax bill that rolls this back.
What did Nancy Pelosi say? She wants to reverse the tax cut plan, right? I mean, she said she wants taxes to go up.
I think the biggest
She may
issue we're
want it,
seeing,
but that doesn't make it happen.
Okay.
Right, but the problem is that we have the personal tax cuts which will run out. They're not permanent, right? And we've also seen Kevin Brady come out and say he want to have a tax plan 2.0.
Right.
So that's the biggest issue, and that's why these midterm elections are important, because we do, if we lose the House, that's a problem. Then we also could possibly get Maxine Waters in a senior position in the Financial Services Committee.
She wants more regulations,
exactly.
not less.
So that's the
Maxine
issue.
Waters.
Last thing the Republicans want is Maxine Waters in charge of the Financial Services.
Remember, the personal rate cuts run out in 2025, not next year or the year after.
Right, but the market's forward-looking, right?
Well,
so as the president even said, as an equity investor, I'm like, they run out in 2025. Do I want to wait till then or get out 3 years earlier?
Markets probably will sell off, though, if Dems take control, right?
It certainly won't help.
Yeah. Exactly.
But don't you think it's probably already priced in? I mean, 35 of 38 times in the president's party has lost seats in the House in the midterm elections.
Right.
So it seems to me the market's already priced it in. It seems to me that the growth policies by the president, while it may be bad for the country, it may have something as crazy as even impeachment talks start coming up, it seems like the economy would continue the same path because the growth policies are in place.
I agree with that. I agree with that. I think
What's not priced in, though, is a flip in the Senate.
Yes.
I mean, you have to look
yeah,
at
but
it.
that doesn't look at all
That would be
very
negative.
likely.
It doesn't, but
If it happened, that would be a big surprise. It would be a surprise to the market and to everybody else.
And then we would see a big sell-off. Because then you are looking at the president's economic policies threatened.
Yes, but he still has this thing called a veto, and there's no chance that the Democrats would have the ability to override a veto in the Senate.
you know what would happen? He would go out and order a veto stamp as big as this desk, and he would make
tweeting it every night.
He would make a public show of him vetoing everything that came across the Resolute desk.
A beautiful veto stamp.
Yes.
Yeah.
So we don't need, I don't think we need to think too much about all of that happening. I think the real risk is not this year, but moving forward as long rates rise. And to the extent that the markets anticipate that, then we could have trouble before the long rate gets to 4 or 5%.
All right, we will leave it there. It's great to see you, Marty. Thanks very much.
Great to be with you all.
Professor Marty.